Hi, everyone. Thanks so much for joining us here today. As everyone is filtering in here, I'll go ahead and go over a few quick housekeeping items, and then we will go ahead and get started. So, welcome to today's webinar, Nexus What Next? We have our entire offering of webinars scheduled. So, if you're curious about those, watch out for our emails, hop on our website. We're doing about one every single week for the foreseeable future, and we do offer CPE credit for all of them. So let's get started here. So if you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. We need you to answer our poll questions as they pop up on your screen. We'll also need you to fill out the survey at the end of this webinar. It will pop up for you automatically. And if you have any trouble with the poll questions, please just reach out to me and let me know. I'll help you sort that out. We do have to record your responses in order to be able to award that CPE credit. A couple other important things here. If you have questions as we're going along, please reach out and ask those questions. You can use the Q&A button in the middle of your screen to do so. We're going to do our absolute best to address them at the end of this webinar or follow up with you via email. I also will be uploading the slides to the chat. They're already on Zoom and they will be emailed to you in 24 hours. So there's a few ways for you to get your hands on the slides and today's handouts. Again, if you have any issues, just let me know. And let's do some quick introductions here. First, introduction for Sales Tax and More. Sales Tax and More, we are a full service consulting and solutions firm. We have a really great team here. Oh, you know what? I'm getting ahead of myself and the slides were lagging, but that's okay. I'll add in before I finish this quick introduction. Also offer pre-record versions of these webinars and our Salt Vault along with a whole list of offerings. So take a look at the slide deck, get on our website, check those out. And again, let me know if you have questions. So Sales Tax and More, we're a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, and like our name states, more. So if you have questions relating to sales tax, please reach out. We'd love to work with you. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well rounded, and he has helped thousands of companies of all sizes and in all industries, and is especially well known for his work in the e-commerce industry. And he is the one who does these webinars with us. So, Mike, if you want to take it from here, let's get started.
Thank you, Ellie, and welcome everyone. Thank you for joining us today. And we're going to apologize a little bit up front here. We're having some internet bandwidth issues, so hopefully you'll be able to hear me all of the time. I'm going to keep my video off. I find that I come across a little bit better when we have the video turned off. To cover today. We're going to do a quick definition of Nexus. Then we're going to talk about next steps. We're not going to spend too much time on Nexus. We've got plenty of other webinars that do that. But we're going to talk about taxability, very high level, materiality. We're going to talk about past exposure. We're going to touch on how states find you. And then we're going to go into the options on how to move forward. And briefly touch on exemption certificates, sales tax returns, and income tax. So a lot to go over today. And as always, the worst time to find out you have problems or that your clients have problems is when you're being audited. And the reason why that's the worst time is it's generally too late to do anything. There are programs out there where the past exposure can be mitigated, and those are usually off the table once a state contacts you. Few exceptions. There's always exceptions to every rule. A state like Michigan, even after they contact you, will let you into a program like a voluntary disclosure agreement. But by and large, most states, once they know who you are, are not going to allow any of these mitigation type programs. So that's why you want to be proactive rather than reactive. And with that, Ellie, let's go to our first polling question.
Absolutely. That question should be up on everyone's screen right now. The question we have is, do you or your clients already know where you or they have Nexus? Your choices are what's Nexus? You've done some preliminary work, you have your Nexus footprint down, or you need some help. And right off the bat here, our answers are all across the board. So we'll give everyone a few more seconds here. Quick reminder again, you do have to answer these poll questions in order to receive CPE credit. And again, my questions really remain, or the answers we have here really remain all across the board. So let's close this out and move forward.
All right. So for those of you who said, what's Nexus? Let's start with a quick definition. Nexus, it's just a fancy word that means link or connection. And when we're talking about taxes, it's the link or connection with the state which must be present before that state can require you to do anything, like collect its taxes, like a sales tax or a seller's use tax, or pay its taxes, like an income tax, franchise tax, or a consumer use tax. So we say it all starts with Nexus because if you don't have this link or connection, the state cannot require you to do anything. So no nexus equals no problems and no responsibility. We're going to have a couple of handouts here. We're not going to get into nexus too much, but economic nexus, that's a big thing since 2018. And this is a great chart. All the software companies out there and even some of the platforms like Shopify say that you just need there to listen to them. They're going to tell you where you have Nexus. Unfortunately, I don't know of software out there or even Shopify that gets granular enough to give accurate information. I mean, they're great red flags. They're going to alert you to a potential issue, but generally, what I see is if you're just looking at the software, uh, people end up getting registered in too many states because each state is a little bit different. So once you get this red flag from the software you're using, I would say use a chart like this in order to see if your specific facts or circumstances require you to get registered. Um, Ellie's also going to be handing out 10 common Nexus creating activities. And when we say common, these are activities that are going to create Nexus in most states, if not all states. The states look at these pretty much the same way, which is the direct opposite of these 12 state-specific Nexus creating activities. And some of these activities, maybe one state will think that it's Nexus creating, or it's definitely not going to be the majority of the states or or all of the states. It's going to be very different on a state by state basis. So we have some great webinars that go into this a little bit more detail. We invite you to come and do it. Today, we want to know what should sellers do whenever there's nexus. The potential exposure is material. What they sell is taxable, and a marketplace is not collecting. Now, materiality is my comment. That's not what the states say. Most states believe you should register from dollar number one once you have Nexus. So I think we need to use common sense. I don't think that just because the state says to do something that we need to do it. If it doesn't make good business sense, then I think that, at least in my point of view, especially when the cost of compliance exceeds the back tax plus penalty and interest, that we can skip it. State doesn't think that you can skip it. I think we can. Most penalty and interest is based upon the back tax. So if you don't have a whole lot of back tax, then there's not going to be a whole lot of penalty and interest. Now, I am a big believer that if your exposure is material, then this is something you need to pay attention to. It's extremely, extremely important, but we need to use common sense when we're approaching this. Now, everyone usually says, well, Mike, what's material? And I can't answer that for you or for your clients. That's something that you have to do for yourself. What I can do is tell you what I can't make the math work. If your taxable sales are less than $3,000 a year, that I just can't make the math work. And in some instances, it's $5,000. So after that, you have to determine what your own personal threshold is. And, a couple of things that our clients look at is risk tolerance. And, we have some clients who literally cannot sleep at night. They're losing sleep. They're making themselves sick with worry, thinking that, a state's going to come and find them. And if this is you, or if this is your clients, then you need to have a lower personal threshold. Maybe you do step in at the $3,000 or the $5,000 level. But we have people on the other end of the spectrum who say, Mike, hey, I go to Vegas every week. I never lose. Nothing bad has ever happened to me in my life, and I don't think the state's going to find me. And if that's you, if that's your clients, then you can have a higher personal threshold. Uh, Profit margins. I talk to a lot of companies and they say, well, we're working really thin here. We are trying to build market share. And that's a whole nother conversation. Generally, as soon as you raise your prices, you lose your market share if that's how you're building your market share. But I see it all the time. Companies working on 2% profit margin. The average sales tax rate's 8%, and penalty and interest is generally going to be somewhere in the neighborhood of 50% of that. So you're looking 50% of 8% is 4%. You're looking at roughly 12% exposure per year. So if you only have a 2% profit margin, not only have you wiped your profits out, if the state finds you 3, 4, 5, 7 years down the road, not only have you worked for free in that state, um, you may have actually put yourself out of business because states talk to each other, and it's not usually just going to be this one state. It may start with one state, but 6 months later, you're getting calls from another 2 or 3 other states in a lot of instances. So profit margins, this is counterintuitive. It's the companies that have the smaller profit margins that are going to be most impacted by this. So counterintuitive. If you say you can't afford it, you're the ones that really need to look at this. If you've got 30, 40, 50, 100% profit margins, you can have a higher personal threshold. I talk to a lot of clients and I tell them, think of it as insurance. I've got a number of rental properties and, some of them are free and clear. The insurance, I don't have to have it. I don't think my houses are going to burn down, but what if I'm wrong? Insurance never adds any value to a property and it's always expensive until you need it. And then the premiums that I pay seem like pennies compared to the benefits that I get. And I look at compliance the same way. Yes, there's a cost of compliance, but the amount of money that you're going to pay for the compliance is going to pale in comparison if a state comes and finds you or your client 5, 7, years down the road, and you got to pay all of that back tax out of your pocket plus penalty and interest. So profit margins play a big role in determining what you believe is material for you when determining what your personal threshold is going to be. And then the third thing is capital reserves. And this was a lot bigger issue before economic nexus. People were willing to roll the dice a little bit more when all they had to worry about was a physical presence. And a lot of people I talked to said, well, we're putting money aside just in case, state decides we do have Nexus. Um, but even big companies sometimes don't have money put aside. I mean, there was one company, they were a huge Amazon seller. They were doing about 50 million a year. Um, Not too huge, but definitely not a small Amazon seller. And the state of Washington found them, and the state of Washington wanted all of their money right then and there. And they had all their money tied up in inventory. They didn't have any free cash flow. It was the fourth quarter of the year. They made most of the money in that fourth quarter, and they had to work out a payment plan with the state of Washington. So capital reserves, if you got a lot of money in the bank, and you can cover this, if a state comes and says, hey, you got to pay us, $500,000 or whatever that number is, if it's not going to impact your day-to-day business operations, then maybe you can have a higher personal threshold. But if it would, then you're going to want a lower personal threshold. And I keep saying personal threshold because you got to remember the states think that you should get registered from dollar number one once you have Nexus. So they don't look at this materiality. They don't look at whether it makes sense or not. Um, so I think we need to do it. Say you have $1,000 in sales. Um, you've got 200 transactions at $5. That's $1,000. State says, well, you need to get registered once you hit that 200 transactions. But if you have, taxable sales of $1,000, the tax on that is going to be roughly 80%. 50% of that, let's double it. Let's say that the penalty and interest is going to be 100%. Well, that would be $160. Now, the problem is some of these states, once you get registered, number one, that's a cost, whether you hire someone like us to do it or you do it yourself. There's opportunity costs there. Um, it takes time to figure out how to do it. But once you are registered, some states want you to be a monthly filer. You state like Georgia, you're automatically a monthly filer when you start out. So now every month someone has to file that return. So again, you hire someone like us or one of these software companies that are going to do it very cheaply for you. And cheap, by the way, in my opinion, is the enemy of good. Um, so or you can do it yourself. But again, it's an opportunity cost. So does it make sense? I don't know. I can't make the math work. How do you, file the returns, 12 returns a year plus getting registered for less than $160? I just don't know how to do it. So we've got to use common sense. We've got to look at materiality. And when the numbers are material, I think that we need to go ahead and get registered. When they're not material, we wait for the states to come and find us. And if they do, we pay them out of our own pocket. All right. So taxability. Uh, Elliot had mentioned the example here. That first picture is a bagel, and that's not going to be taxable in the state of New York. Bottom picture, sliced bagel, maybe you put a smear of cream cheese on that, and all of a sudden it becomes taxable. So taxability can get very, very granular. We don't have enough time today to get into all the different types of taxability, but we're going to talk about tangible personal property and we're going to talk about services a little bit here. Tangible personal property is taxable by default. And whenever people hear the word personal, um, I hear them talking about wallets and laptops and pocketbooks and ties and sport jackets or, something that's personal, something they carry around. They sometimes forget that airplane is considered tangible personal property, that tractor is considered tangible personal property. Tangible personal property, something that can be perceived by the senses. It's something you can touch, you can feel, you can smell. So, uh, there's a lot of tangible personal property out there, and it's taxable by default unless there's a specific exemption. And there are a lot of exemptions out there. The exemptions may be by item, they may be by use or by entity or even by project. So, an example of something that's an exempt uh, by item, groceries. Groceries are not taxable in a lot of states. They are taxable in some states. So if nobody has to pay tax on groceries, then you don't have to worry about exemption certificates. And we're going to talk about those a little bit later. But most of the time, if there's an exemption, you have to document it. So an example of an exemption by use would be a manufacturing exemption or a resale exemption. By entity, it would be local governments or exempt entities. And by project, we run into a lot of contractors or people selling to contractors. And if they're doing a project for an exempt entity, a lot of times that project becomes exempt and they don't need to pay tax on it, but they are doing a project for, just a normal entity. We had one company, they were a steel company and they were selling to a construction company and they were building hospitals. And some of the hospitals were not-for-profit hospitals, some of them were for-profit. So on a project by project basis, same state, same city, same zip code, maybe even, uh, they've got two projects. One of them is going to be taxable and the tax needs to be collected, and the other one was exempt. So tangible personal property is going to be taxable by default. A lot of people come to us and, they don't want to spend money on research or they don't know how to do it themselves. And if that's the case, you're probably fairly safe if you're just going to take the position that what you sell is taxable if what you're selling is tangible personal property. Services, on the other hand, we got to pay a little bit more attention to because services are generally not taxable by default. Services generally must be specifically enumerated in order to be taxable. In other words, the state has to list what services they tax. Now, as soon as I say they're not taxable by default, um, people don't worry about services. And I've got to tell you, more and more states tax more and more services every year because we're a service-based economy now. And most of the states are stuck back in the 50s, with the way that they tax. So they're doing a lot of catch up, and more and more services are becoming taxable. At this point, I don't know of a state out there that doesn't tax at least some services. Every state taxes at least some services. Now, sometimes you can't just look at the big print. Sometimes you got to do some digging. I'll give you an example, the state of Texas. If we look at website design and website hosting, um, if you look at Texas, those are not specifically enumerated services. They're not listed anywhere. But if you look at the last 30 years, how Texas has been implementing, there's lots of cases out there that Texas says that website design and website hosting are actually data processing services. Now, I don't think of data processing when I hear website design or website hosting, but the state of Texas does. And there's long precedent there. So you can't just look at the big picture stuff. Sometimes you got to do some digging. Another example would be South Carolina. They tax software as a service as a communications service. So states are generally going to look at what you sell or what your clients sell through the prism of what they tax. In other words, they're going to stretch it. Um, So, we really, it's not what we think. It's what the states think, and how are the states going to come after us. So we've got to put in some effort when it comes to services. This is one of the areas that I see more companies making more mistakes at this point, and some really smart, advisors out there. Really smart accountants that don't realize how many services are actually taxable nowadays. Some states are going to tax most services. States like Hawaii, New Mexico, South Dakota, West Virginia. These states are the opposite. In these states, services are going to be taxable unless they're specifically enumerated as not taxable. So those are four differences. And as a matter of fact, in South Dakota and in Hawaii, legal services and accounting services are actually taxable services. So New Mexico and West Virginia, not so much. But if you nowadays, a lot of accounting firms have clients across the country. If you're sending out 200 invoices to Hawaii a year, you've got 200 transactions there, then you could be subject to collecting tax on your accounting services in the state of Hawaii. Sometimes a non-taxable service becomes taxable when sold in conjunction with tangible personal property. A great example of this is California. They had an example out on their website back when it was the Board of Equalization who handled their sales tax rather than the CDTFA. But this example said, let's say you're buying some drapes and you take some measurements at home. You're going to put them in the bedroom. You go down, you buy the drapes, and you give the measurements to the person who's selling you the drapes, and whether they actually alter the drapes or they send it out to have the drapes altered. That alteration service is taxable because it's being sold in conjunction with the tangible personal property. Now, you take those drapes home, you hang them up in the bedroom, and you absolutely hate them. They don't look good at all. So you can't keep them in the bedroom. You decide you're going to put them out in the game room or a different bedroom or wherever you're going to put them. So the next day, you take the measurements and you go down to the local dry cleaners or tailors, whoever's doing alterations where you are, and now that's a non-taxable service because it's not being sold in conjunction with the tangible personal property. So sometimes non-taxable services can become taxable when sold in conjunction with the tangible personal property. Something else, bundling. When you're offering lump sum pricing, in other words, one single price for something that may be taxable or uh, include something that's taxable, something that's not taxable. And this isn't just services. This can be for tangible personal property also, like a gift basket. You may have some taxable items in there and some non-taxable items. Services, you may have a taxable service and a non-taxable service. A lot of states say that if you're bundling this together, some states call it bundling, some states call it lump sum, some states call it a mixed transaction. But the gist is if you have taxable and non-taxable and are just offering a not one price, not itemizing, then many states look at that as the whole transaction becomes taxable. So that's something to keep in mind. All right, so let's look at some research do's and don'ts. All right, states, they're going to try to stretch their rules to fit your products and services. But we definitely don't want to try to stretch what the state is saying to fit our products and services. At least not to, we may want to put ourselves in the state's position. Could they stretch to see what selling is taxable? But we don't want to take our interpretation of what the state's saying. We got to look at how the state has implemented this and who they've gone after in the past. So many times people come to me and say, well, Mike, I think that we can make this argument. Well, it doesn't matter what argument you can make. It doesn't matter what you believe, really. It doesn't matter what I believe. Again, it matters what the state believes and what does their past track record show? How do they implement it? So we don't want to try to stretch what the state says. Um, Another big no-no. We don't want to call a state and accept verbal guidance because it's not binding. I mean, an auditor comes in and you're going to say, well, I called the state and they told me to do it this way. And the auditor's going to say, did you get it in writing? And if you didn't, then there's no protection there. Here's another thing. You can call a state, test this out. If you got a taxability question, call a state 3 times in a row. You can get 3 different answers. It all depends on who's answering the phone. So we don't ever want to call a state and accept verbal guidance. What you do want to do is ask the state where to find the documentation. If someone's nice enough to be helping you, you don't want to insult them sometimes. So, my people will say, or, hey, that's great. Thank you for giving me that answer. But my boss is going to want something that, you know, in writing that he can fall back on. Is there some place that you can send me, some type of guidance in writing from the state or an email that you can send me? They're generally not going to send you an email, but there may be a statute that they can steer you to or a publication they can steer you to. Now, when they steer you to it, you got to read it because a lot of times what they're steering you towards will contradict what they're saying. The people at the state are not always giving out correct information. So we actually call the state. If we're doing a research project and we have a question on something, we're going to, form our opinion first. We're not going to rely on the state. We don't want to call the state first and then back into an opinion. We're going to figure out, okay, we believe this is taxable. Here's why. Let's check with the state and we'll call the state. And if they agree with us, it just gives us further confidence that we're correct. If they don't agree with us, doesn't mean we're going to change what we're saying, but we got to go back and relook at it. Are we missing something? And maybe we are. And maybe we find it when we go back and look, but maybe the state's just wrong. So there's a time and a place to call a state, but we don't want to just accept verbal guidance. There's no protection there. Don't assume the competition is doing it right. This is a big issue here. Sometimes a state, use the state of Texas, the state of Texas knows that IT companies, people who are doing, website design and website hosting, they know that they're doing it wrong. So they target the whole industry. State of Massachusetts found a company that was leasing camera equipment and they audited one of their customers and went after this company, and the company said, I can't be doing it wrong. Everyone in the industry does it this way. State of Massachusetts said, well, give me a list of everybody in your industry and we'll make sure they start doing it correctly. So it doesn't matter how big a company is. You can't assume that the competition is doing it right. And these bigger companies, sometimes people have been there for years. The longer someone's been there, I find they don't keep up to date. They don't keep abreast of all the changes that are happening. They're set in their ways. So sometimes they have it, more incorrect than someone who's brand new, because the person who's brand new is going out and checking up on this. We can't assume that the competition is doing it right. Can't rely on an article. An article, who wrote the article? What information were they using to write the article? Now, the article can be a great red flag. Oh, I wasn't aware of this. Let me go check on it. But you don't want to rely on the article. And same thing on a chart. You can't rely on a chart for final answers. A chart could be a great place to start. But so many times, the chart is the middle of the box, and you may be slightly over the line. Facts may not fit the facts that the chart is using. So you can't rely on a chart for final answers. We had a company that said they looked at a chart and and actually a number of companies do this, but this one, it was a much bigger issue. They told us they were selling software as a service and that they wanted to get registered in 20 states. And, I questioned them. I said, well, how do you know that what you're selling is software as a service? And they said, well, because we're remotely accessing software. So therefore, it's software as a service. And software as a service is taxable in about 20 states. So we ended up doing a research project for them. And whenever we do research, I ask them to send, a couple of invoices. I ask them to send a copy of any agreements they have. And I want them to tell me in their own words, a summary of what they're actually selling. Because we want to make sure that we're all on the same page and that when an auditor looks at this, all of their information lines up. Well, they sent me an agreement for downloaded software. They sent me a description of what they do. And right there, the first line, the most important thing in utilizing our software is to download this. And once you download this software, we can remotely access it. Um, if an auditor sees that, you've got to, the agreement they provided is for downloaded software. So even though this software communicates with something else, most states are going to look at that as downloaded software, and downloaded software is taxable in a lot more states than 20. They did not like that. So they you can't just take a chart as the final word. And it works in the other direction too. We had someone else come in and said, "Hey, I need to get registered in this many states because some software is a service." And you know, they were a data storage company, and that doesn't fit the definition of software as a service in most states. So instead of getting registered in 20 plus states, they got registered in like 2 states. So when you're using a chart, you really got to dig in. Whenever you're doing any type of research, you really got to dig in. And, you know, you can't use the chart itself, whatever it says on the chart for final answers. A lot of the services that we subscribe to, there'll be one answer on the chart, and then I click on, their citations, and I'm reading the citation and I'm saying, this chart is not correct. I mean, even based, on the information they're providing, someone has interpreted this incorrectly. So, unless you created the chart yourself, I would not use it for final answers. Same thing, you can't use a frequently asked questions page as your sole source. It's not authoritative. We had someone come to us and say, Mike, I want to deregister in Texas. And I said, how come? They said, well, according to the frequently asked questions page, I don't fit the need to be registered there anymore. I said, unfortunately, I don't think that's correct. According to the statute, you need to be registered. And they went ahead. Not everybody listens to me. A lot of people don't. They said, go ahead and get us deregistered. We said, okay. About a week later, they came back. Actually, it was probably about a month later. They came back and Texas had corrected that page, and now they needed to get registered again. So, um, you know, a red flag. If you see something on a frequently asked questions page, that could be a great source of information, but you got to verify it somewhere. It's too easy for a state to go back and change it. And maybe it's the marketing person for the state, not a tax person, who made a mistake and put it up incorrectly. So, you know, not as your sole source. Here's something else. You can't blindly trust your accountant. And for those accountants who are on the phone with, on the call with us today, you're out there, you're improving your knowledge. But especially since the wafer case, it appears that everyone is a sales tax expert. And unfortunately, some people are not. And most good accountants, if they don't know something, they're not going to talk about it. But they're not everybody's a good accountant. And some of the horror stories out there. Anyone who's ever had a big problem starts off when they come to us and say, well, my accountant told me I didn't need to worry about this, or our accountant told me it wasn't taxable. My accountant told me I don't have Nexus. So you can't blindly trust your accountant. Up until 2018, the majority of accountants out there didn't have multi-state clients. Or maybe they had one or two multi-state clients, but they didn't. Nowadays, everybody's a multi-state client, so it's a whole different world. So, and there's so much other things that y'all as accountants have to stay abreast of. It's hard to stay abreast of all the different things, and a lot of accountants, are basing, something that they learned 20 or 30 years ago. I mean, we had one company come to us. This is, about 8 years ago now. And their fraternity brother was an accountant, and he told them, oh, Nexus has to do with traveling salespeople. Keep everybody in house, and you'll never have any problems. Well, unfortunately, that just wasn't true. And it didn't get caught for about 25 years. But when it got caught, it was a huge issue. So you can't blindly trust your accountant. You got to, when it comes to charts, you got to read the citations on a chart. Ask your accountant how they keep current. Ask them how many multi-state clients they have. Ask them how they know the answer to the question you're asking. And a lot of them have great state and local tax departments. A lot of them have deep knowledge. A lot of them are very good. But some of them, um, are fairly new to this. They listen to a company like Avalara who says, hey, use our tax software and you too can become a tax expert. Well, that's not how this works. There aren't any questions on the CPA exam about sales tax, very few courses in school. This is something that you learn by doing. And if you haven't had a need to do it in the past, it's definitely a lot more complicated. Some people think it's pretty easy. It's like peeling an onion, though, layers and layers and layers. Research sources, CCH, Thomson's Reuters, TTR, they were purchased by Avalara, and Bloomberg, that's BNA. These are some of the major sources out there. There's some minor sources. They can get expensive, though. I mean, we pay about $20,000 a year for our different research sources. And the Salt Vault, Ellie mentioned it earlier on, where we provide access to pre-recorded webinars that provide for CPE credit. We have a lot of information in there too. This is a paid portion of our website. Lots and lots of charts. And as I mentioned before, they're not the be all end all, but they can get you pointed in the right direction. And they had the citations there that you can go out and then look on your own. So these are just some of the research do's and don'ts, or you can go out and you can hire a third party to do the research for you. All right, here's just some information for the Salt Vault. Ellie, let's go to the next poll question.
Yeah, this is our second poll question. Just a little bit of just an easy question we have here. What about sales tax nexus concerns you the most? Your choices are nothing, you have a down, economic nexus, third party, travel, or others. Quick reminder, you do have to answer these poll questions in order to receive the CPE credit. If you're having any trouble viewing this poll question, you can send me your written answer in the Q&A box. Mike, it looks like really we have spread out answers here, but let's give everyone a few more seconds to get their answers in. Um, Again, you do have to answer these poll questions in order to receive the CPE credit. But Mike, let's I guess we can close this out and move forward.
Yeah, it's usually a toss up between economic nexus and third parties. Economic nexus, because it's relatively new and it's constantly evolving. And then third parties. When we're thinking about how we can create this link or connection with a state, we're usually thinking about our activities. We're not thinking about the activities of third parties. Yet there are two U.S. Supreme Court cases that say, yes, third parties, whether you call them subcontractors, independent contractors, or it's just another company performing services on your behalf, they actually, if they're helping to establish or maintain a market, they can create nexus for you. So, uh, that, by the way, is the biggest issue when it comes to nexus, that trips companies up, because it's really defies common sense. I'm thinking about my activities, not the activities of third parties, but a huge issue there. All right, so how do states find you? Well, if you're selling on a business to business basis, auditing your customers. Whenever an auditor goes out, they're not just looking at your sales, make sure that you're collecting the right amount of tax and that all the tax that's being collected is being remitted. They're looking at your purchases, because just because someone doesn't charge you tax doesn't mean that it was a tax-free sale. Maybe they didn't have Nexus and they didn't have a responsibility to collect the tax. Maybe they didn't know they were supposed to be collecting the tax. Again, doesn't mean it's tax-free. You're supposed to self-assess and remit that directly to the state as a use tax. So when an auditor comes in, they want to make sure that you're paying all the tax on your purchases, and they also use it as a prospecting tool. Some states are very formal. In Texas, you have to fill out a lead card for each company that has an invoice. I mean, if they have 10 invoices, you don't fill out 10 lead cards, but each unique invoice needs a card filled out. Now, just because the auditor sees that you're not charging tax doesn't mean you have an issue. Maybe you don't have a responsibility to collect the tax, but you are on a list. And they have discovery units out there whose sole purpose is to find companies that they believe should be paying estates taxes. And they follow up on these leads. Information sharing with other states or even the IRS. If third parties are creating Nexus for you, you generally pay them with a 1099. States go to the IRS and say, hey, give me a list of everyone who's gotten a 1099 in my state. Competitors, we talked about Massachusetts, and this has always been a bit of an issue, but it's becoming a bigger issue since Wayfair, because there are some companies that say, Mike, I want to get registered, but I sell big ticket items, and none of my competitors are actually charging sales tax, and I'm afraid I'm going to lose sales. I'm afraid the states are going to find me, but I'm more afraid I'm going to lose sales and go out of business. So, is there some way I can make my competitors collect the tax? And unfortunately, pretty much every state has somewhere on their website or a hotline you can call to report noncompliance. And some states actually pay bounties. So, um, you know, the competitors can get a piece of what the state collects. But that's a bigger issue with former employees. You get a disgruntled employee, and they know you should have been collecting sales tax and you weren't. Well, not only do they get their pound of flesh, they get paid for doing it. Um, I've seen divorces, messy divorces, where someone turns in a spouse. I've seen partnerships that are breaking up, and one of the partners thinks they're getting a raw deal, and they turn them in. So lots of ways that the leads can come out there. Sometimes it's your customers. Very innocently, they call the state and say, hey, do I need to pay use tax on this item? My vendor didn't charge me any sales tax. And next thing you know, the state's saying, well, who's your vendor? And you're on a list. Some states purchase lead lists. There are companies out there that sell all types of leads. Amazon gives out a lot of lists to states of people who have inventory in their web houses. So, these discovery units are following up on all these different types of leads. And by the way, these are not the only ways that states find you, but they're some of the bigger ways. Web surfing. The state of Washington is notorious for this. Sometimes you'll have auditors going out and they'll, just search the internet. And other states have, specialized software that are looking for certain terms that make it look like you're doing business in a state. They call them web crawlers. So these are just some of the ways that states can actually find you. If a state finds you, in theory, they can go back to the date you first started doing business in the state. And when I say doing business in a state, it's not when your first sale took place, it's when your nexus began. In practice, they routinely go back 7 to 10 years. So let's say you've had Nexus for 20 years. Most states aren't going to go back. They could, but most states aren't going to go back. Most states are going to go back either 7, 8, or 10 years. I don't know of any states that go back 9 years. So 7, 8, and 10 are the most common numbers. But 7, 8, or 10 is still a long time. And the penalties and interest really start to add up. Now, Texas usually goes back 7 years. That doesn't mean they're limited to it. They went after one gentleman that came to us for 12 years. Now, we beat them back and got them to agree to only go back 7 years. But, this was never did more than $75,000 a year in business. He was a pool cleaning company. And he was the nightmare client who brings all of his receipts to you in a shoebox. How's he going to provide 12 years worth of documents, let alone, even 7 to 10 years, he had a tough time. So routinely go back 7 to 10 years. They're going to want all the back taxes, penalty, and interest for the entire period in question. Penalty and interest can quickly exceed 50% of the tax owed. And in most mitigation options are going to be limited or disallowed. So this is why you want to be prospective rather than reactive. All right, so at this point, you're saying I have Nexus or my client has Nexus. Potential exposure is material. The sales are taxable, and I'm selling outside of a marketplace. If you're selling on a marketplace, the marketplace is generally responsible for collecting and remitting the tax, the sales tax. Not so much on some of the other taxes like Washington B&O tax. All right, so there's a step process. And number one, we've gone over already. You got to determine where there is a need to register, and you do that by looking at the nexus, materiality, taxability, and responsibility to file. Who's filing? The marketplace or you? And Ellie, we have all ones here. There's no twos and threes. We got to fix this slide. But number two should be quantify the past liability, if any. And then once you determine your past liability, if there's any there, then you got to determine the best path forward. Do you want to register prospectively? In other words, just picking today's date or a date in the near future? Do you want to register historically? That's using the actual date your Nexus began or some other date in the past. A voluntary disclosure agreement is a type of mitigation program. Amnesty is a mitigation program, and a managed audit. You don't get registered through the managed audit, but you can get registered and then apply for a managed audit. And we're going to go over that a little bit. Let's start with how to quantify the past liability, if any. Well, two ways to do it. Number one is a quick, rough estimate. And we talked about earlier some numbers. Before we get to that, though, you got to determine the first date of Nexus for each state. And once you have that first date of Nexus, then you got to determine the sales by state for the first date of Nexus. And then we use 12%. The reason we use 12%, it's an 8% average tax rate. Some states it's going to be low, some states it's going to be high. We figure out, when we just want a ballpark figure, this is a good number to use. And then we use 50% of the tax rate for the penalty and interest. So that's how we get our 12% number. So you're going to multiply the sales by 12%. It's not meant to be an exact number. It's just meant to get you enough information so that you can decide the best way to register. So that's the quick down and dirty. Now, if you want more precise numbers, and even then it's hard to do because interest rates are going to be the kicker in most of these scenarios, because interest rates change over time, and the time value of money, so it just becomes different. So even if it's not exact, it's going to get you closer to the number, because if you decide you want to do a VDA, you got to know how much money you're going to potentially be spending through the VDA. So there's an exposure review is what you want to do, and you can do that with or without a VDA cost benefit analysis. We do that for a lot of our clients before doing VDAs for them. And the first two steps are the same as before. You want to determine the first state of Nexus for each state, and then you got to determine the sales by state. Only now, instead of multiplying by 12%, you're going to multiply the sales per year by the actual tax rates in each state for the different periods. You're going to do it for the penalty, and you're going to do it for the interest. So you're going to have some, relatively accurate numbers there. Not 100% accurate, but it's going to be pretty darn close. Then you got to determine the VDA look back periods, and we're going to get into this in a little bit more detail, but most states are looking at either 3 years or 4 years. So once you have what your potential exposure is, if the state finds you, now you do it using the VDA benefits and compare. And this is important, especially when we get to VDAs. A VDA is a great tool, but it's not a one-size-fits-all tool. And this can help you determine if this is the right way for you to get registered. As we mentioned, here's the different ways you can register. Let's look at each one of these separately. Prospective registration, sometimes this is what you need to do. Maybe you just crossed a Nexus threshold, and that's all you have to do. But sometimes people say, well, Mike, I can't afford to go back and pay all of that past exposure, or I don't have the mindset to do it. No one ever told me I should do it. So they just want to register going forward. They want to stop the bleeding. So past exposure doesn't go away when you do this, because if you've never been registered, if you've never filed a return, in theory, there's no statute of limitations. So this could be the way that you should be doing it, but a lot of companies, as I said, do this for whatever their reasons are. You cannot do this in every state. Some states are getting very aggressive. Historically, states take you at your word. And if you tell them, your Nexus is just beginning, okay. But there are some states, Arizona, Illinois, Maine, South Dakota, Wisconsin, they are getting very, very aggressive. In Illinois, they are going to audit you. They're auditing everybody. I told the client this 2 years ago, and he fought me tooth and nail. He said, I am not paying any back tax. I'm not doing a VDA. And um, I just want to register prospectively. Okay. Uh, just notified us now. 2 years later, the state's going after him for those 3 years where he was not registered. Um, so if your exposure is material, you really want to look at a VDA, at least in these states here. Arizona just joined this list. We just started getting notices from Arizona that they believe people have not used the correct dates. They send out some nice guys letters first, encouraging you to step forward. And when you don't, then they start sending the threatening letters. All right, we expect more states to be joining this list because a lot of companies out there, roughly 50%, are not yet compliant for economic nexus. Now, here's some problems with historical registrations. You use the actual, problems for the prospective registrations. With historical registrations, you're going to use the actual date of nexus. And states are generally going to want back returns. Now, some states are going to work with you and they'll say, okay, for these older years, we just want an annual return. But for the more recent ones, whatever your filing frequency is, that's what we want. Some states are not going to work with you. If you're a monthly filer, they're going to want, 24 months worth of back returns if that's when your nexus began. They're also going to want the back penalty and interest as well as the back taxes. So penalty waiver should be requested. And if you don't ask for it, you don't get it. It's not always granted, but you don't get what you don't ask for. We've been very successful at getting some, if not all, penalty waived when it comes to historical registrations. And this is the way the state wants you to do it. They want you to go back and use the actual date. Now, here's some common registration mistakes. People nowadays are getting registered for the wrong type of tax. They're registering for a sales tax versus a seller's use tax, or vice versa. Prior to Wayfair, if you were out of state in selling it to Colorado, you would register for the seller's use tax. Now you register for the sales tax. So because of changes like that, a lot of people get this wrong. And it's not uniform. If you're a remote seller in Oklahoma, you want to be registering for the seller's use tax versus the sales tax. So it's going to be different from state by state. Very common mistake as to what type of tax you register for. Registering with the secretaries of state. A lot of these, automated websites make it look like you need to register with the Secretary of State. But if you're getting registered because of economic nexus, I don't know of any states that require that. There's a workaround in just about every state. Entering the wrong start date. This is a trick question. All the states are going to say, when did you start doing business in our state? And I see a lot of companies put the first day they had their first sale. That's not what the state is asking. The state's asking, when did your nexus begin? So a lot of companies enter the wrong start date, you enter the wrong start date, then you got all these back returns. And then registering through the streamlined sales tax program before knowing who will do your returns. I do not like the streamlined sales tax program. I think that cheap is the enemy of good. Very few companies will actually file using this program, someone like an Avalara. If you're okay doing business with a software company, that's fine. Lots of problems. I got to tell you, the software companies, they're our biggest source of referrals because people have problems there. We should be paying them commissions. We have so many people coming to us because it's more personalized service. They need something more than just being a number at one of these companies. Um, you don't have a lot of visibility into the streamlined program. And there are problems like in Washington, they don't file the business and occupation tax. So anyway, these are some of the problems. If you're going to utilize the streamlined sales tax program, know who is going to be doing your returns before you do it, because Krista Sleeper, our operations manager, is says, getting out of the streamlined sales tax program is like getting jumped out of a gang. It's really, really tough. And it creates a lot of problems when you're transitioning from a streamlined account to a normal account. All right, here's another myth. You have to register with the Secretary of State when registering for sales tax. We just talked about that. And let's go to voluntary disclosure agreements. So, as a reward for stepping forward voluntarily, states are going to limit the look back period to 3 to 4 years, waive the penalty, and in a handful of states, waive or reduce the interest. So let's take a state like California. If California finds you, they're going to go back 8 years. If you step forward voluntarily and ask to do a VDA, then they're only going to go back 36 months. So 3 years. So right away, you save 5 years worth of back tax, penalty, and interest. So that could be a great deal. In a state like Texas, if they find you, they're generally going to go back 7 years. You do a VDA, it's generally going to be 4 years they're only going back. So you save 3 years worth of back tax plus penalty and interest. But they're actually going to waive the penalty and 100% of the interest. So there are some great rewards for doing this, especially if you're looking at if the state finds you, how far they could go back. Now, VDA, as we said, generally not available if the state has previously contacted you. And a VDA can be a great tool, but like all tools, it's not for all scenarios. And I'm going to pick on a software company again, Avalara. We get a lot of people coming to us and they say, well, Avalara told me that if I owe more than $500, I need to do a VDA. And then they say, oh, by the way, Avalara charges $3,500 for a VDA and there's no volume discounts. So they come to us, they say, I need to file 40 VDAs. And before they pay $1 of back tax or penalty or interest, they've got, $120,000 invoice from Avalara. I mean, that's ludicrous to me. $500. Why in the world would you pay anybody $3,500 to remit $500 for you? It just doesn't make sense. I don't know how these salespeople, sleep at night. Our rule of thumb is you have to be saving as least as much money by doing a VDA as the cost of the VDA. Otherwise, it doesn't make sense. Otherwise, go and do the historical registration. There are other options for you if you want to take care of that past exposure. But the VDA, it's more structured, more formal, which is why most people are going to charge more for it. I mean, if you're doing 40 VDAs with us, I think the price is somewhere right around maybe $2,100 or so per VDA. We do discount for multiple, but the same thing's true of us. I mean, if you're not going to save at least as much money by doing the VDA as the cost of the VDA, then don't do it. Get registered another way. And that's where the VDA cost benefit analysis really comes in. A lot of people ask us, does it make sense to do this? We'll do this, cost benefit analysis for them and say, okay, here's the 4 states that makes sense to do VDAs in. Here's the, 5 states it makes sense to do historical registration in. And here's the, 30 states can register prospectively. So VDAs are a great tool, but it's not a one-size-fits-all tool. And by the way, while we're talking about this, states will generally try to include income tax in a sales tax VDA unless it's specifically prohibited by Public Law 86272. Amnesties, a lot of people get excited about amnesties, and amnesties, they're generally not true amnesties. Usually a VDA is a better option because in an amnesty, there's generally no limitation on the look back period. They're usually the penalty can be waived. So that's the same as a VDA. They're more generous when it comes to the waiving of interest. Um, they're offered very infrequently and short duration. And generally, state says, okay, everybody's got to take advantage of this. We're going to have it. It's going to last for 60 days. And the last time we offered this was 6 years ago. And who knows when the next time we're going to offer it. And if you don't take advantage of the amnesty and we find you after the fact, there's an extra 50% penalty. So Pennsylvania got themselves in trouble a number of years back. They said, we know who you are. And they started out with a satellite picture. And then they got smaller and smaller and smaller until it finally zeroed in on one house. And with the caption of "We know who you are," the people who owned that house, uh, you know, uh, gave them a real hard time for that. So I don't know what the outcome was, but I know there was a lawsuit. Um, Moral of the story: amnesties are few and far between. You've really got to read the fine print because generally a VDA is going to be the better option. Now, not all the time. The state of Washington, maybe 10 years ago, came out with an amnesty, and theirs was better than the VDA. It had a penalty waiver, it had interest waiver, and there was a limitation on the look back period. So VDA is a better option. Amnesty could be a good option if the state has already found you and you can't do a VDA and there's an amnesty available, but they're generally not true amnesties. People get so caught up in the word amnesty, not realizing they still got to pay, potentially 8 years worth of back taxes. So VDA usually the better option, not always, but usually. Managed audits. California is real big on this. If they've contacted you, you can't do the VDA. One of the downfalls of a managed audit is there's generally no limitation on the look back period. So they're going to go back the full 8 years. If you've had Nexus for 8 years, now, in a managed audit, it's usually performed by someone like us, a third party. It's under the supervision of the state. And because the state didn't have to spend as much money auditing you, you paid someone to have that done for you. Not only is the penalty can be waived, but some or all of the interest can be waived. California actually will waive 50% of the interest. So if they find out who you are, or if you know that they're going to find out who you are, you can ask for a managed audit, and you can end up saving yourself a bunch of money on the penalty and the interest there. And Ellie, let's go to the next polling question.
Absolutely. That should be on everyone's screen right now. Um, let's see, Mike, you're not quite on the poll question page. There we go. But true or false, owners and officers of a company cannot be held personally liable. While you are answering this, quick reminder, you do have to answer these poll questions in order to receive CPE credit. Most people are answering false here pretty quickly, but we still have a handful of answers left that we're waiting on. So Mike, if you want to review this, we can close it out and move forward.
Yeah, and the correct answer is false. They can be held personally liable, especially in the case of tax collected not remitted. And it's not just officers and owners. Sometimes if you're involved in the tax collection and remittance process, you can be held liable too. So you don't have to be an owner or an officer. When it comes to not situations where tax was not collected and you don't have that tax collected, not remitted issue, there are some states who still will hold owners and officers of the company personally responsible. All right, so let's move on to, uh, you're registered now. What's something else do you have to do? Well, once you're registered, you got to either collect the sales tax or collect a properly completed certificate in lieu of collecting the sales tax, which is acceptable to the delivery state. And right now, certificates for companies that have a responsibility of collecting certificates, that is the number one cause for large assessments. And one is an exempt sale, not exempt. Well, when you don't properly document that exempt sale. So it's real important that you're collecting these certificates. And whenever we're doing audit defense, that's always such a big issue. I mean, companies, for whatever reason, are either not collecting certificates at all, or they're not doing a good job of validation. And we're going to talk about validation in a second here. Certificates, even when you have one missing certificate, it can have huge impact. And I use an example. I was involved in an audit, and we got involved after the initial phase of the audit. It was during the redetermination period. And it was a $3.5 million audit. Roughly 65% was due to missing certificates. We got all of the certificates. We found all of them. We reached out to all our customers except for one. And this one certificate was a piece of heavy earth moving equipment, and the tax on this certificate related to this invoice would have been $8,000, which was no one wants to pay $8,000 in tax. However, because audits are done on a sample basis, they usually have an outsized impact on the assessment, because it's not just the tax on that one invoice that you don't have a certificate for. It's extrapolated out over the population, the error percentage. So in this particular instance, that $8,000 of tax grew to be over $270,000 worth of tax. Now, you can generally have things excluded, but we had gotten this audit down to about $17,000, and we could not get the state of Texas to exclude this and have it paid at the $8,000 level, to get it excluded from the sample. I was still ecstatic. We got a $3.5 million audit down to just under $300,000. But if they had collected this certificate, or we could have found them, or they could have found them, would have been that much better. All right, so certificate best practices. You got to have a system. Part of that system is deciding who's going to manage it. Some companies have the sales team do it. Some companies have the credit team. Some companies have the new accounts team. Some companies have the accounting team. So you got to decide who's going to be responsible for gathering the certificates. Once they're gathered, you need to validate them. We said we were going to talk about this in a minute. This is really important. It's not just having a certificate on file. It's making sure that the certificate is going to survive an auditor's scrutiny. In other words, what's the sense of having something on file if the auditor is just going to kick it? So you want to make sure that someone is actually validating the certificates. You want to store the certificates centrally and digitally. A lot of companies still keep them in filing cabinets at the different regional offices across the country. They should be centrally and digitally stored. Process, I don't think, can be fully automated. There needs to be a human element because that validation process, I just don't know of any software out there that can validate it for you. You got to have a human. So you can do it yourself, or you can hire someone like us. We have a great exemption certificate management program. A lot of times, when you're doing validation, it's just making sure that the certificate is completely filled out. You won't believe how many certificates we review that just aren't filled out. So that's important. Here's a big tip. Um, the name on the certificate should match the name on the invoice. Otherwise, it's going to be kicked during an audit. So very, very important. Common mistakes to avoid when validating certificates. Ellie, let's do the next poll question.
Absolutely. Another true or false question here. Even one missing certificate can have a huge impact during audit. And quick reminder for everyone, you do have to answer these poll questions in order to receive CPE credit. Let's let these answers roll in a couple more seconds here, and then we can move forward.
All right. 100%. It is true answer. All right, so let's move on to sales tax return filings. When it comes to that, you can do it yourself. You can hire a third party. Now, when you're hiring a third party, there are sales tax specialists like ourselves. There are existing accountants and bookkeepers, and then there are software companies. And not everybody is created equal. So, when you're talking about existing accountants or bookkeepers, some are great. They've got strong SOL programs, years and years of experience. Some are brand new. Since Wayfair, everybody is an expert. Many are brokers. You may not even know it. The software companies tell them they too can be experts if they just use their services. Avalara is notorious for this. And then these accountants find out after the fact that Avalara just doesn't give them the support. So um, maybe you don't care. That's not everybody has the same concerns, but most people, if they're paying someone to do their returns, they actually want them to be doing their returns and not brokering them out. Uh, the better accountants are disclosing this. Some companies I run across, they don't disclose it. And then when there's a problem, that's when it generally comes up. Managed returns, software companies. So software companies are generally good at software and or marketing, not often very great at services. But there are two different types of software companies. There's a full service company like an Avalara or Vertex. What we mean by full service is that they can do whatever you need them to do. They can file in all states, file all the different types of forms you need, and can balance however you want them to balance. Whereas a limited service company, someone like a tax jar, they either can't file in all states or they can't file correctly in all states, and they can't support different types of balancing options. So not everybody is created equally. So questions you need to ask: who's going to be your point of contact? What is the problem resolution process? Who confirms all sales tax collected is actually remitted? Who tracks the messages in your online account, the filing frequency changes, state fees for renewals, general messages and notices? Um, notice management, that's important. Some companies say, oh, yeah, we have notice management, and their notice management consists of when there's a notice, they let you know they've uploaded it and you got to go out and fix it yourself. Whereas a company like us, we generally don't even let you know there's an issue. We go out and fix it, and, you know, uh, that's part of our notice management. So what types of reports are provided? Who confirms the sales tax is actually committed? So these are questions you just need to ask yourself. Late penalties and interest, who's responsible? We had a company that Avalara was collecting all of their taxes, and for 3 years, they never remitted any of the local taxes in Colorado or Louisiana. And the company said, you're doing it all. You're filing our returns and you're collecting our taxes. We want you to pay the late penalties and interest. And Avalara said, nope. So now they have 5 or 6 different companies with us rather than with Avalara. Ellie, let's go to the polling questions. So just questions to ask. Not all providers are created equal. There are a lot of good providers out there. There are some okay providers, and then there's just some poor providers. So, ask them questions.
And while everyone's answering here, Mike, answers are coming in pretty quick still, but we just quick reminder, this last poll question you do have to answer as well for the CPE credit. You will need to answer, fill out the survey when you exit. It will pop up for you automatically, and it will also be emailed to you in 24 hours. But why don't we close this out and we can wrap up, Mike?
Okay. So why should a business care? Well, past exposure can be so big it can actually destroy a business. The states are getting more aggressive. In many states, owners and offices can be held personally responsible for sales tax, even when tax is not collected. Here's a big one. Sales tax liabilities follow the assets in the sale of a company. A lot of people tell me, well, Mike, I'm selling my company and we're doing an asset sale. Well, I don't need to worry about the liabilities. Well, not so much because the assets follow the liabilities. Excuse me, the liabilities follow the assets. So, um, and more companies, when they're doing their due diligence, realize this. They don't want to inherit someone else's problems, and this is becoming an issue during the due diligence process. And sales tax liabilities generally survive the closure of a company and even a bankruptcy of a business and or its owners. So why now? Why is this an issue now? Well, the states are gearing up to track down sellers because of economic nexus. Some states have already started. It's going to get ugly out there. And while they're looking for economic nexus, they're going to stumble across all types of nexus. And during a recession, states generally need to make up revenue because there's less income tax, there's less sales tax. They got to make it up somehow. And historically, they've increased their discovery efforts during the downturns. So I think this is a perfect storm that we're on the verge of here. So that's why now. Now, going forward, I think income tax is going to be the next big battle. We've seen Oregon introduce a new type of tax that's not protected by Public Law 86272. We've seen Massachusetts say that Public Law 86272 is unconstitutional. And the Multi-State Tax Commission has revised their guidance on Public Law 86272. Basically, they say if you're using cookies, and how many websites don't use cookies now, or if you're doing any post-sale customer service by email or by chat, those pierce the protections of Public Law 86272. So they have virtually eviscerated it. California, New Jersey have already adopted it, and there are 22 states that said that they're going to adopt it. Here's a list of the most aggressive states. This is not an exhaustive list at this point, but these are some of the more common states that we see that are pretty aggressive when it comes to income tax. And Ellie, any questions?
No questions so far, but if anyone has any, please feel free to reach out to us. Mike, we're at time, but did you want to add anything else here quick?
No, we appreciate everyone who has joined us here. We hope that this has been a beneficial webinar for you. And if you have any ideas for future webinars, let us know and we'll see what we can put together. Thank you, everyone, for joining us.